Welcome to this week's episode of the Real Wealth Podcast. And this week we are going to be covering the budget from last week and some of the big implications for business and for savers and people trying to provide wealth for the generations. How is this budget going to impact us? Now, it's always important to first mention that it's never good to be too reactionary to a budget. The political landscape and the tax landscape is changing all the time. But unfortunately, certainly for the last 10 years plus, the situation has been getting progressively worse, certainly for business owners and those that are trying to provide wealth for the long term. And this budget is unfortunately no different. The landscape for the next 4 years isn't looking too pretty. What did we see from Rachel Reeves last week? Well, we've seen that there is a continuation of this stealth tax to income tax. There's very little movement in any of the bands that dictate what percentage tax we're going to be paying, and ultimately that's going to lead to this kind of sneaky stealth tax we see all the way to 2028. They're not planning to make any inflationary adjustments to those bands until 2028, so we've got a long road ahead of us as inflation continues to erode the general wealth of the UK population. Now, overall, this was not a budget for growth. The statistics tell the story in its entirety. There is a forecasted 1.5% growth throughout this plan, and even that does not factor in the per capita GDP growth. So when you look at per capita GDP growth, it is clear that as an economy we are shrinking. So we're not going to see a huge amount of growth. We're not going to see a huge amount of reduction in the levels of overspending by the government. We're going to continue to take on debt, certainly through the first few years of this budget. So whilst it feels like we are buckling down for a tough time, the advantages of that aren't seen until a good few years down the line. So few major concerns throughout this budget for me. Big one is inheritance tax, and we'll get into the details of what's happening with that, but that really is limiting the ability to pass wealth down generations. So there's a lot more scope coming into inheritance tax, especially for business owners. It was very clear. Keir Starmer made a speech last month where he said that asset owners are not working people. The Labour government were always going to be about trying to protect the working people, and promised that there weren't going to be any major tax implications for working people. I'm not sure that's entirely true given the stealth tax on income tax and not raising the bands. However, it's clear that the big losers in this situation are business and asset owners. So let's get into some of the details, starting with income tax and national insurance. So I've spoke briefly already that they are not really moving the bands of income tax, which means if you go back to 2008, when we had a 40% income tax band, there was around about 1 million people that had to pay 40% income tax. Now fast forward to 2024, because of this stealth tax of not increasing the bands, not keeping the allowances in line with inflation, we're now at a situation where there's over 8 million people that are having to pay higher rate 40% tax. So there is a huge additional tax burden in totality over the working person, and that, as they said, is not going to change until 2028, when they will start returning to inflationary rises on those allowances. The big one really when it comes to income tax and national insurance is obviously the rate of employers' national insurance. So that is going to hit business owners. 1.2% increase doesn't sound like a lot, but it's actually in reality a lot more when you consider the tax-free allowance on employers' national insurance has gone down from £9,100 to £5,000. So you're paying 15% on a good bit more of their salary. Overall, on the average £35,000 salary is going to cost the employer about an extra £1,000 a year. So again, it's going to be small businesses that pay the price on that. We've also seen an increase in the minimum wage. Inflationary busting, 6.7% increase from £11.44 to £12.12 per hour. So whilst that is good news for those people that are on the minimum wage, again, smaller businesses are going to have to pay the price on that one. The next thing on pensions and ISAs, there was a lot of concerns running up to the budget. There was going to be big changes in this, that there was going to be reductions in the tax-free amount that you can take out of your pension, the 25% tax-free amount up to £268,000 for individuals. They didn't touch that. So there was a bit of relief. I know on the run up to the auction there was a lot of people that were scrambling about trying to take their tax lump sums on their pension, and that is at the moment untouched. The same with the ISA allowances, etc. So not a lot to talk about in terms of pensions, other than the inheritance tax changes that we'll talk about in a little bit. Now, as a business owner myself, and speaking with a lot of other business owners, the major concern that a lot of people had coming up was capital gains tax, and there has been some fairly significant changes to that. So capital gains taxes on shares, business shares, used to previously be 10% and 20%, the basic rate and the higher rate. And now that's going to be brought in line with the property capital gains tax rates of 18% and 24%. So a sizable increase in the capital gains tax you have to pay when you sell shares and make a profit. But the major one for me was, we've always seen some really good incentives for entrepreneurs selling the business, insofar as only having to pay 10% tax for capital gains purposes on the sale of an eligible business. Now, eligible business means that you qualify for business asset disposal relief, and up to £1 million you had this beneficial tax rate of 10% that you could pay. That regime is changing now. There has been a reduction in the relief, and now is set to rise to 14% from the 6th of April 2025, and by the 6th of April 2026 that will be brought in line with the lower rate of 18% for general capital gains tax. So what you're going to see over the next little while is a rush for a lot of businesses to sell off. You will remember in one of my previous podcasts we talked about a lot of baby boomers coming to retirement age. There's a lot of companies out there that are up for sale where baby boomers are retiring, they don't have a succession plan, they've not got any other members of family to take on those businesses. There is a huge transfer of wealth happening there right now amongst the baby boomers. There's a huge amount of opportunity for anybody who's entrepreneurial and trying to get into business, because there's going to be the opportunity to buy all these businesses. These tax changes are just going to accelerate that process. You'll find a lot of people that were on the fence about making the decision to sell the business or not are now in a position where they feel like they have to do it to take the benefit of these lower rate taxes prior to April 2026 when the full changes kick in. So that has potentially a big impact on what we're going to see in the business sale market over the next 24 months. So where are the other big changes in the budget? Inheritance tax is probably one of the most significant ones. Now, you'll remember I've spoke I think throughout several podcasts about inheritance tax. We're all about generational wealth in our business. We are trying to create wealth in our lifetime that can see generations of our family into prosperity, and inheritance tax planning is critical to that. It's clear that this government is trying to maximise the amount of inheritance tax, and they can minimise the amount of wealth that is transferred down the line to family members. These changes throughout inheritance tax make that clear. We already had a major challenge with our buy-to-let portfolio insofar as the protections that are offered from inheritance tax for trading businesses do not transfer to businesses which invest in property, which are essentially investment businesses. They don't have the same level of inheritance tax protection. In the worst situation, you would find yourself in a position where you've built up significant amounts of assets in terms of property, you pass on to your children, there's a huge inheritance tax bill, and they have to sell off the majority of the properties to be able to pay this huge tax bill. And property is generally quite illiquid, so all you've done is create a massive problem for your kids. Now, we've managed to structure our affairs in such a way to put the majority of the value of those companies into trust to avoid that situation. On our trading business side, we always had that expectation of protection from inheritance tax because trading businesses are dealt with very differently. That gap is starting to close. So let's talk about some of these changes. So exemption on business property and agricultural land are to be capped at £1 million. Any amount over £1 million are going to be taxed at 50% of the inheritance tax rate, which is, the inheritance tax rate's at 40%, 50% of that means you're effectively paying 20% on any value over £1 million. So those trading businesses that used to be protected, passing them down the line for inheritance tax purposes, no longer have full protection. If they're worth more than £1 million, there is going to be a tax bill that needs to be paid. And similarly for the farmers out there who have huge wealth tied up in land, they run the risk of having to pay a significant chunk of inheritance tax. And the question is always, when you're passing over assets, where is the money to pay this tax? Because you've not sold the asset, there's no realisation of wealth to be able to pay the tax. You end up having to sell off some of the assets just to cover the tax bill. So it's a pretty major hit. It's a pretty significant change and a very clear indication from this Labour government that they do not want significant amounts of money passed down the generations. And the sad reality of this situation is the really wealthy people that have built up wealth over generations understand the strategies to be able to avoid these major inheritance tax implications, whereas it's the middle of the ground guys who have managed to build up a bit of wealth through saving and working hard in their lifetime that end up getting hit with these significant inheritance tax liabilities, and ultimately their family have to scramble to figure out how they're going to pay it. The other thing to mention on inheritance tax is AIM shares now will only receive a 50% business relief reduction, not 100% under the £1 million. So effectively you're going to be paying 20% inheritance tax on any AIM shares. That's the alternative investment market shares passed down the generations. And finally, on inheritance tax, the big one, any unused pension pots will now be included within the valuation of an estate from April 2027, which is going to significantly increase a lot of inheritance tax liabilities for families. So, saving up all your days to build this massive pension pot that you don't use before you die with the hope of being able to pass it on to generations, that is going to be hit significantly with inheritance tax. So some really bad news for a lot of people there, business owners, savers, anybody that's trying to create generational wealth. You're going to have to learn the advanced strategies of how to try and structure your affairs in the best way possible to try and avoid some of this damage. Finally, property. Again, a lot of speculation leading up to the budget, what the government were going to do with property taxes. The first thing they've done is raise the additional dwelling supplement, or the second home tax, from 3 to 5%. It's always really important, we're based in Scotland, to understand what part of the tax system is controlled in Scotland, what part of the tax system is controlled at a government level. This specific property tax is controlled at Scottish Government level. We're already at 6% ADS. England is now just coming more in line with the rates that Scotland are, going from 3 to 5%. So, for anybody buying second properties or building a buy-to-let portfolio, that's an extra tax that you're going to have to pay on the acquisition. We've tend to find, even although it's significantly higher in Scotland, we use it as a negotiating tool to try and further discount the properties that we're buying. So we haven't honestly seen a massive impact in that as buyers of property and building a buy-to-let portfolio. It's tended to hit sellers and exiting landlords much more significantly, because other investors that are buying property are not willing to pay the same level of price because of this extra tax. So I don't see that being a major hit for England. The one thing that I'm quite keen to see, and we haven't heard from the Scottish Government yet, whether or not they're going to follow suit with England on multiple dwellings relief. So as portfolio landlords, we regularly buy portfolios of properties. Multiple dwellings relief gives you an exemption on this tax, this additional dwelling tax on 6 or more properties. That's been a fantastic tax saving for us over the years in buying all the portfolios we have. They abolished that this year in England. We still have multiple dwellings relief in Scotland, so it remains to be seen whether or not the Scottish Government are going to follow suit. We'll hear about that later in the year. So overall, not a great budget. It was built up to be a really bad budget coming for anybody who's trying to build wealth in the long term, for anybody who's a business owner, entrepreneur. Was it as bad as we thought it might have been? No, obviously that was their intention, to build us up for a massive fall, only to scale back some of what came. There was concerns about potentially a wealth tax, which would have been catastrophic for a lot of people who are asset owners, effectively saying, even although you've not sold the asset, even although you've not realised the gain, you still have to pay tax on an annual basis based on any increase in the value of your assets. Well, how do you pay that? Because you haven't realised any cash to pay it. It's a little bit like the inheritance tax liability. If it's tied up in assets, how do you pay it? You have to sell off part of the asset or the entire asset to be able to pay the tax. So wealth tax is something that's been talked about for years. It's hard to see how in practice they would implement it. They scare us with it every so often, but thankfully there's no sign of it yet. Overall, I think the other thing I'd like to mention is the fact that Scotland in this budget has had an unprecedented level of funding by the government. It was an uncomfortable day for the SNP party. Obviously there's a reason why Labour are putting so much funding into Scotland, because they sense blood in the water. The SNP's lost a huge amount of ground in this election, and Labour see an opportunity to step in there when we come to the next Scottish Parliament elections. SNPs have not been good for us as landlords. There's been a huge amount of anti-landlord rhetoric from the SNPs over the last 8 or 9 years. Everything that they are worried about in England right now, the repeal of Section 21 evictions, we've already had that in Scotland. We've already had the higher ADS in Scotland. We've already had the more stringent PRT regulations as landlords in Scotland. Scotland has led the charge on anti-landlord rhetoric for so long through the SNPs. Certainly a lot of landlords are going to support or be supportive of the SNPs losing power in Scotland, and it seems to be the way it's going to go. Are Labour going to be significantly better for us as landlords? It's very unlikely, but it certainly can't get any worse than it's been under the SNPs. So overall, Big changes in inheritance tax, big changes in capital gains tax, income tax is not looking any better. We are one of the most complicated tax systems in the world. 21,000 pages worth of tax legislation is not getting any more straightforward, and taxes continue to increase, whether it's through stealth taxes and not increasing the bands, or whether it's through genuine increases in tax percentages. It is becoming unsustainable. We've seen a huge amount of millionaires leaving the UK over the last few years. It's doubled almost year on year since COVID. Almost 10,000 millionaires left the UK last year. The only other country, and I've said this so many times on the podcast, the only other country that had more millionaires leave it last year was China, that had 15,000. And when you consider the population difference, it's staggering in percentage terms how much people are abandoning the UK. And okay, who cares about millionaires? They're rich. They spend money, they build businesses, they bring economic growth to the country. This budget, this government is talking about economic growth. There's none throughout the process of this budget. 1.5% GDP growth, not factored per capita growth, so it's a net reduction. The government is not making the changes they need to grow the UK economy. They think investing in infrastructure and public sector spending is going to drive economic growth. It's not. It's bizarre. You know, they've done a huge amount to destroy business confidence in the lead up to this budget, and a lot of the statements that they've made. It's a worrying way we're going. But the reality is, unless you're in a position where you can look at becoming non-resident of the UK and you can move, you just need to find ways around this, to hustle harder, look at the more advanced tax strategies that you can have to try and protect your wealth for the future. If it was me, if I was in a position, I'd be seriously considering moving myself out of the UK, but it's just not an option. So we will continue. We'll look at more advanced tax strategies. We'll look at ways around some of the major liabilities that are coming our way over the course of the next few years. I'm really interested to see what happens on business sales. I've spoke about this as a massive opportunity. With all these baby boomers coming to retirement, there's now a massive tax incentive to sell your business very quickly. So like everything within there are some opportunities that we can latch onto and take forward. So that's my summary. A lot happening in this budget. It obviously had to be a big one for Labour as their first budget, but when you combine all the changes that's happening in the UK with the election in the US that's coming this week, there is a huge amount of change coming our way over the next few years, and we need to be on our toes as entrepreneurs to stay in line. Okay, that's all from me. I'm Alex Robertson. This has been the Real Wealth Podcast, and thanks for joining us on this wealth journey.